TheoTrade. This is Don Kaufman. March 12th, 2021, doing the TheoTrade weekend update here on a Friday afternoon. Interest rates just soaring to the upside. The big question is, can the market hold it together in this next week of trade? And yeah, a lot of it is going to deal specifically with interest rates. We're going to be talking about bonds on this weekend's update because I'll tell you what, the FED Cometh. Yeah, well, St. Patty's Day is going to be a fun-filled Fed fest as, of course, the FOMC is meeting this next week. And they're going to have some decisive policy changes, we believe. We're going to discuss that here on this weekend's update. Let's actually get to work. One of the first things that I want to discuss on the update here is on the edge of expected. Now, for those of you that tune in and day out, week in and week out, we talk extensively about expected move. And we talk about that expected move in what we term the mother of all products. Now, for those of you that are not necessarily in the know, what is the expected move? The expected move is what the option marketplace depicts risk to be. And I'm just going to show you. There are three highlighted lines on the screen. Okay. The central line is where we start the week, the upper edge of the expected move, the lower edge of the expected move. Now, these are lines that we draw on a Friday afternoon. And just like we've already drawn, of course, this next week of trade, which we'll discuss here in a few minutes. But again, this next week coming into, the week of March 15th, it's already drawn. And I'll talk about the expected move there. The point being is the SPX is the most, by far and away, dominant product in the entire marketplace. And the gamma inside of the SPX drives order flow to the entire marketplace. But the edges of these expected moves are hit with incredible frequency. And again, this is how the option market depicts risk. In this last week of trade, like literally the SPX expected move was sitting right off $100. It was plus or minus basically $100. So you're supposed to go $100 higher, $100 lower. And to look at this on an intraday chart, now we're actually going to take it down to a 1 day, 1 minute. Okay, that was a line that was actually drawn last Friday. You saw it on the video. And, the part that's just absolutely uncanny about this is the SPX is roughly a $4,000 product. A $4,000 product can close anywhere it wants to close. The edge of the expected move was $39.4150, and it closed within, what, $2 of that. I mean, not even a rounding error away from the edge of the expected move. And this is something that we have, pointed out. It's just been marquee week in and week out. In fact, on last weekend's update, we talked about the incredibly high probability of tagging the upper and or lower edge of the expected move in, of course, this next week of trade. That's exactly what we did. In fact, we're going to have more of that discussion right at the end of this update. We're actually going to talk about, well, next week's expected move. But that was just shockingly tight marketplace that drove us right to the edge of the expected move. And again, always keep in mind, the SPX, that's what drives order flow. Okay, say what you will about a marketplace, but the SPX is a $4,000 product that's doing 1.2 million contracts. That thing is going to do anything it wants because, again, it's a monstrous amount of capital surrounding that because the SPX does 1.2 million contracts. You look at something like the spiders do another 4 million contracts. I mean, the spiders and the SPX are roughly the same thing. Then you get a product like the VIX. The VIX is actually based in the SPX. That's good for another 600,000 contracts. But then you look at the S&P options on futures. Guess what? Those are also based in the S&P. I mean, they're all the same thing, right? And you wonder why the marketplace adheres to those edges of expected. Okay, let's, so I had to get that out of the way. Let's get down to business. It's a rally! So the S&P has bounced back. And bounced back, well, according to the SPX, almost precisely 100 points. You get a 100-point move in the SPX to the upside. But now let's compare and contrast that to other major products. If you're tech, well, you're not that happy. But if I apply auto-expected moves, in terms of auto-expected moves, one thing you do want to see is the QQQ did in fact actually not only rally, but it did crack the upper edge of the expected move and pull back inside of it. So net, yes, even the QQQ had a decent week. I mean, the bounce in there was nothing less than magnificent as the week progressed. And then of course, we have to talk about none other than the Russell. the little engine that could. The Russell is just blistering right now to the upside. And again, that's something I really want to focus on here for just a moment. So I want to push aside the fact, whatever. You know, the SPX, people are like, it's a blistering rally into all-time highs. Okay, none of that matters. It did exactly what it was expected to do. It did. Exactly what it was expected to do. You look at the QQQ, you're like, well, the QQQ also adhered to the edge of the expected move. The Russell's, that's something special. Okay, and again, let me take off the expected moves and just show you how vicious this move happens to be. And the other thing I want to look at is like the year-to-date percentage. It's already up 20% year-to-date. So the Russell explodes, okay, higher, and it opens up all kinds of opportunities. Some of the opportunities that I would look for in here, I'm all over, like gamma iron condors. Now, the IV ranking, and I'm actually going to display this on a chart. The IV rank is incredibly low. Like, look at this. When I say the IV rank, okay, this is volatility unto itself. So a lot of people that trade options, of course, like cruise into the volatility and they're like, okay, what's the volatility? You open up like the 35-day options, like, okay, it's about 31%, yada, yada. But 31% doesn't necessarily justify anything. You don't know where you stand when you say, well, the volatility is 31%. Where's volatility been over the last year? Well, that's what this ranking does. Okay, ranking actually looks at the volatility right here and right now versus, okay, where it has been. And when you rank this, this is actually, in effect, okay, the lowest volatility effectively that we've seen. And that's one of the things that you kind of want to keep in mind over here. It's pretty much some of the lowest implied volatility that we have seen, all right, inside the last year. And so that's the IV ranking, but there's a better way to even do this too. If you want to look at like a study, go to volatility studies, just cruise up here to implied volatility. This is looking at the actual implied volatility, which has collapsed back down. It's collapsed back down quite considerably. But IV rank is, again, inherently low at this point in time. And that actually opens up the opportunity. And you're like, so who cares? Whatever, man. IV is low. Okay, so if implied volatility is low, Skew is actually incredibly high in here. But the point being is if you're looking for a product that you want to be on the buy side of some options, not the sell side, actually, the buy side of options, okay, we're actually going to do things like buying gamma irons in here. And what a gamma iron is, you go out maybe like 35, 42 days, we're actually going to buy an iron condor in there throughout the course of the week because with explosive moves like this, let's actually determine one thing. Direction. You can't determine anything inside of the IWM. You're just not going to be able to determine that. I mean, it exploded to the upside. Maybe it takes back off to the downside. Literally, you know, last week, we almost made money to the downside in a gamma iron, and then all of a sudden we exploded back up and made money to the upside in the gamma iron. It's total free for all in here. But I actually want to be, and this is interesting because I want to be on the buy side of premium inside of the IWM, but I want to be the sell side of premium in most of the other products, which is, it's interesting because what you're actually getting in something like IWM, it's moving more than volatility is paying you for. And that's why I want to be on the buy side of options. So that's some of the Russell explodes higher and opening up opportunities. Okay, let's get down to business now. The FED cometh. So if you were hiding under a rock, okay, this thing called the FOMC, you know, Federal Open Market Committee, the Fed, Jerome Powell, okay, they're coming. And they're coming on St. Paddy's Day. Yes, it's going to be Wednesday, March 17th. The bonds have very little time to make a statement, okay? So I'm going to tell you exactly an opinion on this to begin with, okay? And then I'll actually give you kind of the lowdown of what we're actually seeing in the marketplace. But I want to start with the opinion piece. Okay, the marketplace really only has Monday, okay, maybe early Tuesday to make a statement. What statement do I believe the marketplace is trying to make? And I've been talking about this a lot, okay? Here's the statement, okay? You don't control me. That's what they're trying to say to the Fed. Okay. Moreover, what the bond market is really trying to do, I think the bond market is actually trying to test where the Fed is likely to use rhetoric, initially rhetoric, to step in. Okay. What I'm saying by this is the bonds are just, they're hideous at this point. You know, you look at the bond product and you're like, whoa, look away, I'm hideous. Okay, this is some strong sell side activity inside of the bonds. I mean, I've seen some pretty wild things inside of bond products before, but you can open up even 3 years. You can open up all kinds of years. Sell side activity like this. Like, I get the rally here. I mean, that's COVID, right? So the entire world jumped into bonds. Like, I get that. But in terms of recent history, Okay, you can go back pretty much as long as you want. And there's times back here where we were talking about, tapering and so forth. And this was a very, very different time frame, okay, after presidential election and so forth. But you got to go back some serious time to see this strong of sell-side activity inside of the bond market. Okay, and with that, what it's basically doing, and now we're going to look at the TNX. The TNX, by the way, is representative of the 10-year. And the way to read this, okay, it's not like a 16% interest rate. It's actually 1.64%, which it's exploded. The other way to actually look at this, and I like to do this, I like to bring this up on a year-to-date percentage and go like, hey, don't worry, the 10 years only up 78% on a year-to-date basis. It's like the Tesla, of like Tesla last year was flying like this in the beginning of the year. Anyway, neither here nor there. The point of me actually bringing this up, I think that this is actually trying to push the Fed to the edge. Okay, I think that the bond market right now is trying to feel out where the Fed's likely to step in. And what's the Fed going to do? Okay, so rates, they're sending Jerome Powell a message. What's the message? Okay, we're dangerous. You don't control us. And we're going to send out a little bit of a test package over here. So bring on the FOMC. So as I said, okay, they had to make a statement today, right? They're probably going to continue that statement a little bit, maybe Monday and into early Tuesday, but there could be some more selling inside of bonds. Okay, the one thing I'm going to tell you inside of the bond market, at least the way that I'm actually trading this, okay, and you better have, this ain't for the faint of heart. I'm going to tell you right now, I'm out here and I'm actually selling premium, okay? I am selling premium in some size now inside of the bonds, both 42 and 70 days out, but I'm selling puts. Okay, why am I selling puts in there? Because I absolutely think the Fed is going to step in and do something. Because if the Fed continues to see the sell side activity inside of the bond market, it's over. I mean, the economy is not going to be able to sustain, ever increasing rates. Like if the 10-year, okay, and I just want to show you, if this 10-year came up to like 2%, 2% is not that far away. That 10-year comes up to 2%. That's going to have a huge impact. And and forget, like, people are like, well, are people not going to buy houses? Are they not going to do this? Okay. Stock buybacks are going to cease because capital is not going to be, dirt cheap. A lot of the carry trades that are done in the marketplace are going to start to unwind. There is so much riding on this, okay, that it's incomprehensible to even look at the S&Ps right now and try to justify where the S&Ps are going to go, technical analysis, fundamentals. To me, absolutely unequivocally nothing matters. All that matters right now is the bond market. Okay, and you have to key into this. And by the way, if you don't believe me on this, don't take my word for it. Just go look at the volume. Okay, go look at the volume inside of the ZN. I mean, the ZN is doing 2 million contracts. 2 million contracts inside of the ZN. The S&Ps aren't even doing that. The S&P futures are not even doing 2 million contracts. And that's the thing that people have to get through your head. Okay, the entire professional world right now is watching what's going on inside of the bond market. So, okay, bring on the FOMC. So what's the FOMC likely to do? And again, this is completely my take over here. Let's look at the yield curve for just a moment. So we're going to up the yield curve. By the way, if you've never seen this, this is the U.S. Department of Treasury website. Oh, it's a wonderful website. There's absolutely no advertising on it. That's the only great thing about the about this particular site. What you're looking at, right here. Okay, that's actually the yield curve specifically for today. And what I believe they're going to do, and again, there's a couple of versions of this. There's what they call YCC. That's yield curve control. I've talked about that. But then there's also Operation Twist, which is actually used a little bit after the financial crisis. And what Operation Twist was basically doing is they were trying to cool off, okay, the longer duration of the curve, right? The 10-year, the 20-year, and the 30-year. When I say cool off, what they were basically doing is they were actually going to they're going to turn around and sell portions of this curve, and then they were actually going to buy the notes, okay? So they're going to buy like the 7-year, they'll buy the 10-year, they'll buy the 20-year, they'll buy the 30-year, and by buying those bonds, they're actually driving the interest rate back down. And that was again, it was something called like Operation Twist. And quite frankly, okay, I do not think for a second, okay, that the Fed is going to call this YCC, which is yield curve control. Okay, they don't call it that really anywhere other than maybe Japan. Japan has actually used the phrase like yield curve control. And the moment that you actually start to talk about yield curve control it's likely to revert the bonds back up again. So I believe that, again, that the bond market is actually testing, by selling off, is actually testing where Jerome Powell will step in. And the moment they step in, these things will fly. Initially, they're just going to use rhetoric. They're going to threaten the bond market here, because if yield curve control comes into play, you're almost like eliminating an entire asset class. Like, forget bonds. We don't need bonds anymore. Yield curve control is designed to control and to lock bonds within a specific range, so volatility dies out. Okay, but you see anything but that right now. Now, this has incredibly strong implications right now, people. Incredibly strong implications for the financials. Okay, every ounce of sell-side activity inside of the bond market is being met by buy-side activity inside of the financials. Okay, and I'm going to tell you right now, if you are long financials, you are one brave individual, because people say don't fight the Fed. You're right, don't fight the Fed. Yeah, that's why I'm short the financials, because I'm not going to fight the Fed. Right now, I think the bond market is actually fighting the Fed. They're selling the bonds. They're not going to let it go that far. Okay, I mean, listen, the Fed, it's in their best interest to keep those rates low, keep the economy humming along, and to actually institute something like the TWIST program. So the implications for both financials, okay, and energy could absolutely be dire. And when you start looking at stuff like energy, XLE is up 41%, but here's my personal favorite. You got to go to the XOP. The XOP, which is that's a little bit more of a wild child over there. It's oil and gas, okay, but it's like drillers and so forth. That's up 53% year-to-date basis. XOP, the object of my affection right now. So the implications to those two products are going to be wild. In fact, here, again, as I said, don't take my word for it. You start looking at stuff like the XLF, the financials. You don't think of the financials as being like rocking in terms of volatility. The financials are up to a 28% implied volatility. Okay, so the financials are showing some pretty strong volatility in there. You're like, well, 28% volatility. How does that compare to something like, I don't know, like Apple? Okay, Apple's got a little bit of a higher volatility, but this is an individual product. Okay, the point that I'm trying to make over there is like, yeah, that's some rocking volatility for a major ETF. Okay, onward and upward. There's a couple of funky things in the marketplace I also want to point out in this weekend's update that are actually making it very advantageous to still sell premium, like in areas like the S&P still sell some premium on the put side inside of the QQQ, and that has everything to do with Skew. Skew is still magnificently large. Skew is the out-of-the-money puts versus the out-of-the-money call implied volatility. It's incredibly high, okay, and still remains high at the 140 handle. What this basically is doing is it's saying that the markets are still pricing in a tremendous amount of tail risk, okay? And if you think of Skew, and forget about the dots on the screen for a second, but if you think of Skew, okay, this is distribution curve. They're pricing in tail risk out here. Like, instead of the distribution curve being nice and beautiful, it's got a tail. Okay, it's actually pricing in abnormalities to the outside, and that's the out of the money puts. Those out of the money puts are trading for a huge premium. The next thing I wanted to bring up is the VIX. Don't let the VIX fool you. The VIX is actually down to one of the lowest points. Then again, the marketplace is near all-time high, right? It is at an all-time high. But then you look actually at back-month volatility. Check this out for a second, okay? Watch carefully. The 67-day options in the VIX, okay? They're pricing volatility here, okay? When I say here, just above the 27 level. These are the at-the-money options when you're 67 days out. So they're already pricing. Volatility is going to revert back up, and not just back up a little bit. I mean, oh, we're like a 20 volatility. Yeah, well, they're already pricing, okay? They're already pricing the 67-day vol to be back up at like, this actually says about 27.20-ish, okay? And again, all you have to do is look at the volatility futures, and go 68 days out. There it is, 27.15 to be specific. That's the volatility future. The volatility future is what actually prices, okay, the VIX options. So the VIX options, okay, are a completely different animal. The other thing you have to realize, okay, the VIX options themselves, and this is stuff that like people just don't dig into enough. The VIX options themselves are still seeing rather extraordinarily high, okay, volatility. This is actually what we call the VVIX. It's the volatility of the volatility index. The VVIX is still what we term in the VAMA zone. The VAMA zone is anything north of 110. So even though the VIX itself, and everybody goes, it's okay, man, we can come out of the cave because the volatility is lower. Two things that actually stand in the face of that, okay? The VVIX, first of all, is sky high. The volatility of the volatility index, meaning that the VIX itself is going to be rocking and rolling, okay, in the next like 30 days. The other aspect of that is that the VIX, the forward future of the VIX, is already pricing in reversion back up. Now, to compound the issue, yeah, there's a lot of skew. That means those out-of-the-money puts inside of the SPX are rocking. And let's complicate things even a little bit more, okay? These are things that are just really, really odd. I mean, I've seen some crazy stuff, but I've never seen this stuff at like markets at an all-time high. This is the SRVIX, and I brought this up, okay, literally for like the last couple of weeks, but this is the interest rate swap volatility index, like an over-the-counter marketplace for swap vol. And it just continues to go up. There is a problem, people. There's a problem when swap volatility right now is almost back where it was during COVID. And you're like, well, and there's been repo issues. And again, I can go on all day. I don't know, okay, what the means to this end happens to be, meaning I don't have a conclusion off looking at interest rate swap volatility, okay? I don't have a conclusion off of it. I just don't. And you got to be honest with yourself, but not only is the VIX funky pricing, the VVIX still looks extraordinarily high, and the Skew looks incredibly high. But then you got to look at like Tlt volatility, okay? And TLT and like some of the bond volatility, okay, is also like in here. This is something I was bringing up on Wednesday night, but like bond volatility, let's just bring this to let's bring this situation to a head. TLT volatility is now 23%. Okay, TLT volatility is basically like 23%. There it is. Okay, here it is, 22%. But if you actually look at what they call VIX style volatility, the VIX style volatility is literally, all right, and that's actually done right here on thinkorswim. That VIX style volatility is at 23%. So what am I saying? TLT volatility has now eclipsed S&P volatility. It's on, people. There is something big going on in this marketplace. Last but definitely not least, we're going to head into a quadruple witching. It's really more like a triple witching, but don't get all kinds of nervous. There's a lot expiring this week. You have futures markets that are rolling over, okay? The futures contracts are going to expire. When I say the futures contracts, listen, don't let that, be too daunting, but the March contract rolls over to the June contract, whatever. It's already in the midst of a roll, and you can actually see like the roll of the contract going on right now. What else has to happen? The SPX options have a primary expiration. Now, this absolutely does make a difference, because when the SPX options expire, I'm actually going to tighten this up just to about 8 strikes. Okay, there's actually 2 expirations now, and there's actually a Friday morning expiration. Okay, and there's a Friday afternoon expiration. What's interesting is the amount of liquidity that's in both of these. Okay, it's just literally billions and billions of dollars. Like, look at the open interest. This is the Friday morning. Look at the open interest in here. This is just on the put side. Okay, the open interest is nothing less than, it's billions of dollars. But then you actually look, okay, you should also look at the Friday afternoon, okay, and the contract size isn't as high, but there's still some size trading in this thing, okay. The expected move is going to matter just a tremendous amount during this expiration. The expected move of this coming week is 73.54, and I got to tell you, okay, I am not surprised to see the expected move contract, but I would absolutely unequivocally assume that we're going to tag again the upper end or lower edge of the expected move, and that expected move, it's updated weekly in the TheoTrade site. We actually put a link for the expected move in there. So with quadruple witching over here, but the expected move is going to carry a huge people amount of gamma risk is going to come off that board late in the week. Expect that it's the bond market, though, that if volatility is really going to hit the S&Ps, it's going to come from that bond market. All right, that's it on this weekend update here for March 12th, 2021. Have a wonderful weekend, everybody. Bye-bye.